You want to learn about investing because it's a smart thing to do. You try to do some research, but there is so much information and jargon that you don't even know where to start. With the rise of social media, anyone can pretend to be a financial expert, but most of them have never set foot on the trading floor. I used to be an engineer who didn't know anything about investing. When I wanted to learn about the financial markets 10 years ago, I couldn't understand a damn thing. Everybody who was talking about finance seemed to contradict each other, and I got the impression that they didn't know what they were talking about.
We can put that check in a money market mutual fund, then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
So, with my tech background, I moved to investment banking to understand the financial world and how the rich make money. I learned some industry secrets that completely changed my understanding of investing. I believe that everybody deserves access to the best financial education, so today I will summarize my 10 years of experience in very simple language. And I will reveal my personal investment strategy.
Raise your hand if you want to get rich. All right.
Have you ever heard of the expression money makes money? It's not just an expression, it's real. The reason the rich get richer is because they use their money to make more money. And the money it makes more money. It's a virtuous circle. If you were not born rich, then your only chance is to start investing little by little until your investment makes more money than your job. Actually, 88% of American millionaires were not born millionaires. Most of them just invested from the early 20s until retirement and became self-made millionaires thanks to the magic of compounded profits. Compounded interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. This quote is not from me, it's from Albert Einstein. Einstein made many amazing scientific discoveries and won Nobel Prizes for it. But I think he also deserves a prize for this quote, which perfectly summarizes how our financial system works. There are two types of people. Those who invest and save and earn compound profits and will eventually become millionaires. And those who don't invest and will be financially squeezed by the rising cost of life. That's called inflation. You get it. Smart people invest their money to build financial freedom. When you invest, you buy what's called a financial asset. An asset is a resource that has economic value. Its value can either grow over time or pay you money. Either way, assets are your friends. They make you rich. The places where investors can buy and sell assets are called financial markets. You can think of them as marketplaces where on one side there are buyers and on the other side sellers. When the buyer and the seller agree on the price, then they have a deal and execute a transaction.
So do we have a deal?
Deal.
The marketplaces are typically organized by type of asset, and here are the main markets. The bond market is where our government and companies issue debt and pay interest rate to investors. The stock market, also called equity market, is where large companies issue shares. Buying a shares gives you a tiny ownership of a company. Crypto exchanges is where people trade Bitcoin and other cryptocurrencies. The real estate market is where people buy and sell houses or commercial buildings. The commodity market is where companies buy and sell electricity, oil, wood, food, metal, and other raw material. And the foreign exchange market, also called FX, is where companies exchange foreign currencies. For today, I will focus on the stock market because it's the most accessible, the easiest to understand, and the most profitable for long-term investing. The stock markets are huge. There are 60 major stock exchanges across the world, listing more than 69 trillion worth of shares. And just to help you visualize how colossal the stock market is, with 1 trillion bills of $1 each, you could go around the globe 3 times. Now, imagine $69 trillion. You could cover the entire land on Earth. The stock markets are absolutely gigantic. And do you know why they're so big? Because this is a place where investors make big money. And the more money they make, the more they reinvest. and the more the company grows. This is the virtuous circle of capitalism. While people who keep overspending go into deeper and deeper debt, those who choose to invest get richer and richer. To build financial freedom, you want to belong to the bright side of capitalism. If you want to learn about the other markets which won't be covered today, hit the subscribe button to be the first notified of my future videos. When beginners think of investing, they often confuse it with trading, but these are two very different things. Investing is believing in the long-term future of a company and ignoring the short-term noise. When you invest, you just buy and hold the stock for 10 or 15 years. It works because thanks to technological progress and innovation, our economy grows. Trading is making money out of the short-term noise, driven by irrationality, speculation, and short-term strategies. Trading means that you believe you're smarter than the market. If you think that the price of an asset is too low, then you're going to buy. And if you believe that the price is too high, then you're going to sell. And you're buying and selling against another trader who is doing the exact opposite. So you both individually think that you're smarter than the other, but there can be only one winner.
In the end,
There can be only one.
What you win is what the other side loses, and vice versa. In other words, trading is a zero-sum game. Top traders can make considerable profits, but it's ruled by very sophisticated players. You're playing a zero-sum game against the world's top investment banks and hedge funds, who not only have billions, but armies of traders, data scientists, researchers, risk managers, and market data that you don't have, and infrastructure that you don't have. I've been on the other side, and honestly, you don't want to play that game. It would be like taking over the US Army with a slingshot. Just like that. Don't do it, guys. If you want to see the data, look at that. Brokers have the obligation to disclose which percentage of their retail clients lose money at trading. And it's staggering. Look at this bloody massacre. Nearly 80% of retail traders lose money at this game. This is the data from the top 100 biggest brokers in the world. It's as comprehensive as it can get. And that's why I don't trade. And I encourage all beginners to leave tradings to the traders and instead focus on long-term investing. Before you invest in any type of asset, you should always understand the mechanics of that market and how it's going to generate profit. Never put a cent into something you don't understand. It's the best way to lose your money. Long-term investors make money in two ways via the stock market. One, capital gains. There are increases of the share price. So imagine that you bought a share of Amazon 5 years ago. At that time, the share price was $800. Now, it's $3,656. Doing the math, your investment has appreciated by $2,856 in 5 years. Thanks to Uncle Jeff Bezos and the hard work of his 1.3 million employees, your initial capital of $800 is now worth 457% more. This is called capital gain. Young companies like Amazon and Tesla are in the hyper-growth phase. They're sexy, glamorous.
Care to have a little fun? Care to have a little fun?
And all new investors are chasing them because they generate the most capital gains, as long as they can sustain their growth rate. Does that mean that investors should only look at high-growth companies? It's true that mature companies are not growing at the same pace. And from that angle, they lack sex appeal. So to make themselves attractive, they pay dividends to their shareholders. Dividends are a redistribution of a company's earnings to its shareholders. To understand how companies pay dividends, I first need to explain the basics of compounding accounting. Companies listed on a stock exchange are called listed companies. They have the obligation to publish their financial performance on a quarterly basis. One of the key documents outlining their financial performance is called the income statement. On the income statement, companies publish their gross revenues and expenses. Gross revenues minus expenses equals net revenues. If and only if they have positive net revenues, they may take the decision to pay dividends to their shareholders. What's left after paying dividends is then called retained earnings. Paying quarterly dividends is harder than it seems. It requires businesses to be profitable every quarter, which is possible only when they have a fairly stable, predictable business. Dividends are great for investors, but it involves taking cash out of the company, which is money they won't be able to reinvest into their expansions, R&D, or to improve their productivity. Even if they're profitable, companies have no obligation to pay dividends. But many mature businesses are known to pay steady, regular dividends. And the more the business is predictable, the higher the dividend they can pay. If you want to check how much a company pays in dividends, look at what's called dividend yield, which is the dividend paid per share divided by the share price. For example, Apple is a sexy, fast-growing tech company that generates a lot of capital gain. Apple's dividend yield is only 0.59%. It means that if you buy $100 stock of Apple, you would earn 59 cents of dividend. Whereas Coca-Cola is a mature established business. They would pay 2.95% to their shareholders. To recap, the stock market goes up when companies are doing well, and investors make money through capital gain and by receiving dividends income. Now you should be thinking, okay, but what am I supposed to do? Invest in the high growth or the high dividends companies? Do I need to spend days and nights comparing all the companies in the world to know which ones are the best?
What do I do? What do I do? In the name of God, you've got to tell me!
No, don't worry. I've explained to you the mechanics of the stock market because I want you to understand how it works. In practice, investing is simpler than that. I've spent 10 years in the financial industry. I've worked with many traders, asset managers, analysts who manage billions of dollars. I've seen their strategies, their return, their risk, and after all these years, I came to the conclusion that there is only one strategy that I should follow. And you might be shocked by how simple it is. Before I reveal my investment strategy, please like this video and subscribe to my channel. I'll share everything you need to know to be financially free. My investment strategy is that simple. I buy ETF. ETF stands for Exchange Traded Fund. It's an instrument that replicates the whole performance of a stock index, such as the S&P 500 or the FTSE 100. To give you an analogy, stock indices are like football leagues. Indices categorizes companies into different leagues, and the S&P 500 is the equivalent of the first league. It regroups the top 500 largest American companies from two stock exchanges, the New York Stock Exchange and the Nasdaq. The S&P index replicates the average performance of these 500 companies. If a company underperforms, it will be kicked out of the index and be replaced by a better performing company.
This is Sparta!
At the end of a football league season, the losers at the very bottom are relegated to the second league and replaced by new contender. Same for stock indexes. Buying an ETF on the S&P 500 is equivalent to investing in the top 500 highest performing US stocks in just one click. So, by holding an ETF, my money is always invested in the top companies. Stocks that generate a lot of capital gain make me money. Stocks that pay dividends make me money. I just have exposure to the whole market.
Woo! More money, more money! Ah!
Investing in an ETF is called a passive strategy. It has been made possible thanks to John Bogle, the founder of Vanguard. He wanted to give small investors a simple way to get into the stock market. John famously said, "Don't look for the needle in the haystack, just buy the haystack." At the time, John was mocked and ridiculed by Wall Street. But today, Investing in ETF has become the #1 most popular strategy of educated retail investors and recommended by all good YouTubers.
Seriously, if all you did was just buy into a total stock market index fund and then wait 20 years, you will have outperformed most active hedge fund managers, and you would put yourself in the best financial position possible to make the most amount of money.
Long term though, you'll probably end up making money because the stock market has been the best performing asset class in the entire world.
And by Tony Robbins and Warren Buffett. And this is what beginners can't get their head around. What? Your entire strategy is to buy the whole haystack? I thought investors were supposed to be smart and find the needle in the haystack. Guess what? The entire Wall Street tries to find that needle in the haystack. And here is their dirty secret. They're incapable of finding any needle. Apart from exceptions like Warren Buffett, nobody can freaking predict the stock market. You can't believe it? Look, it's even on the headline of the Financial Times. 99% of actively managed US equity funds underperform. What's underperform? It means that their investment strategy generates less profits than their benchmark. And benchmark is just financial jargon that means S&P or Nasdaq index. Let me read that out loud for you. According to the analysis, 99% of actively managed US equity funds sold in Europe have failed to beat the S&P 500 over the past 10 years. Only 2 in every 100 global funds have outperformed the S&P Global. And that's for the US market. But you might wonder if it's any better outside America. So let me keep reading. Almost 97% of emerging market funds have underperformed. Daniel Ung, Director of Research at S&P Dow Jones Indices, said, "The figures are startling." And yes, they are. Let me repeat it to make it super clear. More than 90% of the guys graduating from MIT, Harvard, Oxbridge, wearing £3,000 bespoke suits, talking jargon language on Bloomberg News and on the FT, trying as hard as they can to beat the market, can't do it. It's not because they're stupid. Most of the asset managers I've met are between quite smart and extremely smart. They just can't beat the market. Researchers have tried to understand why mutual funds underperform. And you can read the whole report if you like the intellectual masturbation, okay? It's quite complicated. The link is in the description of this video. But here is the short answer. Companies are driven by humans, and humans are not easily predictable. In case you're still not convinced, I've interviewed Will Rennie, a former asset manager with 15 years of experience. He has managed billions of dollars of pension funds and researched all the investment strategies you can think of. Hear what he has to say.
But actually, investing can be very, very simple. Essentially, just put your money into a fund which invests in thousands of companies, and you just put some money in every month, just like you would put money into a savings account. And then over time, just let that grow.
In summary, ETFs are the simplest and most efficient way to invest. I told you, my investment strategy is that simple. Most people try to automate their savings and try to actively manage their investment. I do the complete opposite. I manage my expenses very closely, and I leave my investment on autopilot. Because saving is the only hard part of investing. And the more I save, the more I can invest, and the more I'll make money. Since 2000, the US stock market has grown at an average of 10% per year. This is an average, okay? So there were good times and there were bad times. And no one has a crystal ball to predict when the bad time will strike. That's why you have to see investing as a long-term game. Don't expect to get rich overnight. If you ever come across a get-rich-quick, easy money scheme, stay away from that. It's a scam. Investing means taking a short-term risk for a long-term expected gain. In the short term, the markets are volatile. They can go up and down, and no one can predict the direction. And look, I don't care, because I invest in the long term, and in the long term, companies tend to make more money. And when they make money, I make money. So when I invest, I think forward and ignore the short-term noise. US companies have been so far the best performing. Will it be the same in the future? Well, no one can tell for sure. But here is what I have noticed. All the rich people, the large companies, the pension funds are heavily exposed to the US economy. If there is one thing I learned about rich people, it's that they hate losing their money.
Michael, do you hear me? I want my money back. Give me my money back. You mother.
For example, when the world entered lockdown, the whole market crashed by nearly half. People who had jobs were screwed. Investors were screwed. Everyone was screwed. So government stepped in, printing trillions of dollars to stimulate the economy, which caused high inflation. What's inflation? It's the general rise of all prices in an economy, the goods, the services, the assets. The stimulus helped the stock market to recover in no time, and it even reached record high levels. Governments can't let the stock market crash forever, because this causes a domino effect. Unemployment rises, people get angry. Pension funds crash, and retired people get angry. The big companies financing the politicians get angry. Rich and affluent people get angry. Basically, politicians can't let companies down if they want to be re-elected. So what I'm saying is that the financial system is using the political system as a safeguard against downturns. But the good part is that I don't even need to lobby. The world's most powerful people are already doing it for me. The second I become an investor, I join the side of the most powerful people in the world. And they're the ones lobbying and working to make my money grow. That's why we say that investors have money working for them rather than working for the money. It's time to invest if you meet these two requirements. One, you're free from any expensive debt like credit cards or overdraft. The best you could hope when investing is to generate a 10% annual return. So if you pay 20% interest rate on your debt, then start by getting rid of it. I see people investing because it has become cool and trendy, although they're still in debt. And they always come up with some funky excuses like, yeah, but I need to buy Tesla and GME right now. The math is very simple. 20% is higher than 10%. So I don't care what are your reasons to invest while you're in debt. If you're against the math, you're wrong.
Listen to me, you're wrong. And if you don't get it, I feel sorry for you.
2. You already have built your safety net. You need to have enough savings to survive without income from 3 to 12 months. How long to survive is up to you. What matters is that you have enough money to feel safe and cover the unexpected. When you know that you'll be safe for 1 year, no matter what happens in the world, you'll feel more confident about investing. For example, if you have nothing in the bank, the idea of investing and losing £100 will feel dangerous. But now, imagine that you have saved 10k. Then investing 100 is just 1% of your money. Your mind will be at peace to play with 1% of your net worth. And as an investor, it's super important to feel comfortable with your financial situation. Because the last thing you want to do is panic when the market is down. Scared money is loss-making money. When people panic, they sell at the lowest point instead of waiting for the storm to pass.
That's not right. How can the price be going down? Something's wrong. What are they doing here?
They're selling, Mortimer.
Well, that's ridiculous.
There are ETFs to replicate the performance of almost any market. I like to invest in the S&P because it's the most diversified and gives me the exposure to the US biggest companies. There are many platforms where you can invest in ETF. I use Vanguard because I've always respected this institution. John Bogle created Vanguard to democratize index investing, to help people like you and me take control of our investments without paying expensive fees to Wall Street. While the likes of Robinhood and Citadel paid millions of fines for screwing their retail investors, Vanguard always remained true to the value of its founder and always acted in the best interest of their clients. They offer the cheapest and the most transparent access to ETF. However, the website and their interface are really not sexy. I'll show you quickly how I navigate through my Vanguard UK account. In the UK, the most tax-efficient account to open is Stocks and Shares ISA, where you can invest 20k per year tax-free. It's crazy when you think about it. People who work are taxed at 50%, but those who invest, they pay zero taxes. I don't like the blended funds because they have higher fees, so I go to the equity funds. There's a selection of 33 indexes and I like to invest in the US market. And here is where I select the S&P 500. I can either transfer a lump sum of at least £500 or set up a monthly direct debit of at least 100 per month. I know it's not as friendly as all these platforms that allow you to invest from just £1. So Vanguard is better suited for those who can already afford to invest at least 100 per month. If that's not your case, then I recommend you to watch my video on my method to save money, and I'm sure you'll be able to spare 100 every month. I also like Vanguard's transparency because most investment platforms hide their real fees behind so much jargon. The Vanguard's ETF on the S&P 500 costs 0.07%, and their yearly admin fees are 0.3%. If you guys know a cheaper platform, let me know. I would be happy to do a review. But to my knowledge, this is the best deal we can get as retail investors. Then, I always keep track of my finances with Nova Money, which categorizes my transfers to Vanguard as investment and not as spending. So, at the end of the month, I know exactly how much I've spent, saved, and invested. Alright folks, I've told you everything you need to know about investing and how I do it. Investing is super easy. The only hard part is saving your money. The more you save, the more money you'll make investing. Now it's your turn to take action. I've included the links to Vanguard and Nova Money in the description. If you made it until here, then smash that like button and subscribe to my channel. Thank you guys. Make sure you're investing in your financial education. Make sure you're building your financial freedom. And I'll speak to you in the next video.